Good morning, everybody. It is Tuesday, August the 4th, and here's what we're following this morning. Banking and energy giants put European earnings front and centre. Global tech diverges as hyperscalers beat chips, and US futures push higher. Plus, President Trump says his latest offer of talks is the last chance for Iran.
Well, Anna, this is the picture in markets at this time this Tuesday morning. Futures pointing higher on both sides of the Atlantic, in fact, breaking with the losses that we've seen in the Asian session already. We already had the S&P closing near a record high yesterday, but set to add to gains both sides of the Atlantic, as I say, this morning. Minding the geopolitics when it comes to commodities. Brent higher 1.4% at $84 a barrel. Trump says, as you say, the talks with Iran are the last chance. Iran says, what talks? But then we also have an eye on the yen. We are weaker today, 157 per dollar. This is the first decline we've seen in, I think, 5 days. We're keeping an eye out for more intervention, though, from both the US and Tokyo. The countdown to the opening trade starts right now.
Good morning, everybody. Welcome to the programme. So I mentioned in the headlines there that we've got some big earnings out of big oil and big banking. Well, HSBC is the banking part. Oil comes from BP. So let's talk about what we're getting from BP. And at first glance, all of the numbers look to be better than had been expected for this UK-listed oil major. If we go to the net profit line, that's coming at $5.73 billion, well above the estimate of $5 billion there or thereabouts. We're also getting net debt coming in below estimates, which has often been an area of focus for this business. Adjusted EPS comes in ahead of estimates for the second quarter, 36.9 cents, and that is against an estimate of 32.6, so that looks to be better than expected. So lots of beats. Operating cash flow also beating, and we're getting a bit of a bit more detail around where the business goes from here. Lizzy, the CEO, setting out 5 priorities, talking about asset sales and talking about what the priorities will be from here: disciplined investing, reduced complexity. And I think the focus on strategy is warranted, because this is a new CEO, Meg O'Neill, who's come into this business and has delivered a step change when it comes to asset sales and reshaping the business. Well, where does it go from here? Are we still very much in this transformation period? When do we get to the growth phase? And so that will be important to keep in focus. Yeah,
they want to see more than asset sales. They want to see more than debt reduction. They want to see that there's actually a foundation for this momentum to keep going in the quarters ahead. Of course, politically interesting as well. Yeah. We'd had this announcement from BP that they're going to put the UK North Sea oil business up for sale. Clearly, that's politically symbolic. Clearly, it's financially significant as well. I'm really interested to hear what Meg O'Neill has to say to you when you speak to her later.
Absolutely. So that'll be coming up in just over 10 minutes' time. We'll be speaking to the BP CEO, Meg O'Neill, 7:15 a.m. UK time. But that's not the only earnings story. As we've been saying, big oil and big banking, and HSBC certainly in focus, Lizzy, with numbers out there. Francine's been talking to the CEO, and we have the numbers out, which seem to look pretty strong in terms of the Q2 profit number looking strong, and the buybacks.
Yes, indeed. $1 billion share buyback from HSBC announced in this earnings. A really upbeat tone from George Elderherry when he was speaking to Fran in my show in Daybreak earlier on. So they're resuming the buyback. They've raised their cost savings on the profit beat, second quarter pre-tax profit, topping estimates, and they're expecting net interest income of at least $46 billion in 2026. They've increased their cost-cutting target, and so all round, a good set of numbers from HSBC, and some really interesting comments on AI as well when it comes to that conversation with the CEO.
Yeah, I thought that was really interesting with Fran's conversation, talking about AI, and Elderherry saying that he is personally tracking AI token costs and license fees, which I just find that's brilliant, isn't it? The idea that there are CEOs all over the world tracking in real time what they're spending on tokens. I think that's quite a sign of the times, perhaps. Let us talk about some of the other earnings that are coming through this morning. Lufthansa stood out to me, Lizzy, as interesting. Net profit there coming in below estimates, margins coming in below estimates. They've got new full-year guidance, but it's a pretty wide range, and they've taken a big hit on fuel, as you might expect. Fuel costs taking €750 million out of these numbers strikes also an area that there is a positive dynamic. Air freight doing better than previously because, of course, Middle East shipping being disrupted. But that's an area of focus. Zalando also stood out to me as interesting. I'm not sure other earnings stories on your radar.
No, Zalando indicated lower by double digits on Tradegate after the back of their results. A big retailer, a kind of Amazon of Europe. For me, that also stood out. But we should also talk about some of the US earnings that we've had overnight and expecting later on. We had numbers from Palantir, raising their revenue and income forecast for the full year. Second quarter sales beating estimates. The language, though, from Alex Karp, just really interesting. The CEO saying that it was otherworldly, the commercial demand for the data analytics tool. And then when he was talking about growth in Europe, because we've discussed a lot about some of these governmental contracts with France and the UK, he says that sales growth in Europe, frankly, in his words, sucks.
Yes, and in the US, the growth is staggering. So there you go. There's the contrast in terms of Palantir. But in terms of the tech narrative overnight, I think also, yes, Palantir has been part of that. And actually, the after-hours move in Palantir was quite positive, wasn't it? Up 15%, as we see there on our screen. So that is worth mentioning. But I think the divergence between hyperscalers, and this is kind of last week's story into this week as well, between hyperscalers and chips, is worth noting. Hyperscalers back, especially the cloud, of course, and we saw Amazon continuing to do well yesterday. And Amazon actually, it's nearing Microsoft in terms of value. And Amazon, the value is now over $3 trillion. Hyperscalers last week, I saw you mentioning this at the end of Daybreak, Lizzy, the biggest outperformance versus the rest of the NASDAQ on record. And we did see a bit more of that yesterday. So hyperscalers do seem to be putting in something of a return to these markets, despite all of our focus on memory and everything that's been going on in South Korea recently.
So earnings, a massive focus today, of course, especially when we've got SpaceX coming out later on. And that's, of course, the first set of numbers since the IPO. And the stock, of course, has tanked since then. So we'll keep an eye for whatever Elon Musk says on that call. But we've got to talk about the macro picture, as we do every day, when it comes to the latest in the geopolitics in the Middle East. And Brent up 1.1% today at $84 a barrel. Really, traders keeping an eye on these talks between the US and Iran. You could say, what talks? Tehran denying that there are any negotiations taking place at all, but Trump saying that in these talks it is the last chance before, and I'm using his words, decapitation. Tensions high, but perhaps there's hope of progress. What we do know is that Iran suggested talks with Oman to get ships moving through the Strait of Hormuz are making progress. So a bit more looser-lipped when it comes to that. But Trump angry here, and therefore perhaps why oil is a touch higher this morning.
Yes, Trump angry and calling the Iranians duplicitous because they continue to say that they're not having any talks with the United States, emphasising instead the talks they're having about that third passage, that middle passage through the Strait of Hormuz with the Omanis. So we'll wait to see if we get any progress on that. The narrative hasn't moved on a huge amount, has it, in the past 24 hours? But as you say, Lizzy, oil prices are a little higher, perhaps on the back of that nervousness around, Trump's anger there. We've got hardly any ships, at least with transponders on, passing through the Strait of Hormuz. So that continues to be the case. And President Trump is lashing out at who he thinks is responsible for the fact that gasoline prices are still elevated in the US. And he thinks that he blames some of the big oil majors there. Exxon, Chevron says that they are making too much money and they need to pass more of that on to US consumers.
And interesting that the MLive team says crude futures look too low for this level of, so little diplomatic progress and so little physical progress when it comes to the Strait of Hormuz.
OK, let's tell you what's coming up on the show today then. We talked about the numbers out of BP and we've got a bit of detail about the path ahead for BP. We're going to be speaking to the CEO, Meg O'Neill, will be with us shortly. We'll also get into an earnings conversation with the Continental CFO, that is Roland Welzbacher. That conversation coming up a little bit later in the programme. Increasing margins, selling premium tyres, pricing power, part of the conversation in that interview. Chris Watling will be with us, Longview Economics global economist and chief market strategist. Miles Bradshaw, JP Morgan Asset Management, head of global aggregate bonds. It still seems that as if the market conversation is casting its mind back to Walsh last week, isn't it, Lizzy, and thinking about where that's left us.
Yeah, a long hangover this week. Well, let's also turn over to what we're watching out for today. Of course, the data, because of that lack of forward guidance from the Fed chair, increasingly important. So stateside we'll get numbers including factory orders, JOLTS job openings and durable goods. We're also, as we've alluded to, going to get a raft of US earnings from SpaceX and AMD. And we'll have in politics US primary primary elections being held in Kansas, Michigan and Missouri, as well as Washington, ahead of that November 3rd general election.
OK, let's go to some other M&A news that we've had out this morning, Lizzy, which is probably worth just getting to because it's been an M&A deal that's been in the works for a little while. Prologis has reached a deal to buy Segro for about £14 billion. This is a UK-listed real estate business, and this offer has been on the table for a while. The recommended... the offer is now being recommended, so that's the headline, I suppose. And for a while, this has been in the works. The total deal equity rises to £14.3 billion. That's 1,054 pence per share, including the final dividend. There's a bit of detail coming through here. But anyway, the headline being that we have reached a deal there
14
on this
billion.
particular UK asset.
All right. Well,
another UK asset. Another one. And going.
Well, coming up on the programme, the yen weakens for the first time in 5 days after a historic intervention by Japan and the US. So we'll discuss where the currency might head to next. But first, it's a busy morning for European earnings. At the Open, we'll be joined by Louise Dudley, Global Equities Portfolio Manager at Federated Hermes. Up next, though, we're going to discuss the earnings conversation with Meg O'Neill, the CEO of BP, off the back of their numbers. And if you've got any questions of your own for our guests, please do share them with us on IB plus BBTV Go. That's the function on your terminal. And this is Bloomberg. Just over 45 minutes to the opening trade. This is the picture in futures. We are 0.5% higher on Euro Stoxx 50 futures, seeing gains across the continent. And that is in contrast to what we saw in the Asian session, but matches what we're seeing in US futures and Nasdaq futures up 0.7% this morning.
Lizzy, let's get into some of the corporate earnings stories this morning. We've heard from BP then, and just to recap what they've told us, second quarter adjusted net profit coming in well above the estimates at $5.73 billion. If you look at the EPS number, that is above the estimates. Lots of these numbers, including operating cash flow, better than expected. The dividend per share, a little higher than expected, and net debt lower than expected. So all good so far. Let's speak to Meg O'Neill, the CEO of BP, who joins us on the programme this morning. Meg, really nice to have you with us. I've just gone through some of the numbers that have beaten estimates or come in better than expected. How pleased are you with these quarterly results?
Yeah, thanks for having me. It's a pleasure to be here. Look, it's a very strong quarter for us. So $5.7 billion of underlying earnings, $2.5 billion higher than the first quarter of this year. Really pleased with the strength of the underlying business. So when we look at the upstream business, 2.2 million barrels oil equivalent per day produced. We refined 1.5 million barrels of oil per day. And we have our world-class trading and downstream business that ensures we're getting the energy products to customers when and where they need them. Now, when we look at what does that mean for the corporation or for the group, it reduces our total financial obligations by about $7 billion compared to the first quarter of this year. We're taking steps to high-grade the portfolio, which will drive improved returns. In my stock exchange announcement, I lay out 5 priorities for the group. And if I were to simplify that, it's all about getting fit to grow.
OK, that's a really interesting phrase, Meg, because that's exactly where I wanted to go next. This is a business that's been in transition, and you have really lent into that transition, delivered quite a lot of transition, cutting costs, selling assets, reducing debt, and you've set out more asset sales this morning. Are you ready now to go into a growth phase, or is this still a business in transition?
We still have quite a bit of work to do. So I've been with BP for 4 months now. I'm very pleased with many of the things I've seen. It's a group of really amazing people who are very focused on delivering the highest value for the corporation and growing shareholder value every single day. But that said, there are significant areas for improvement. The balance sheet is first and foremost an area of challenge. You know, we're carrying financial liabilities when compared to the size of the corporation that are just too high. So we've got to strengthen the balance sheet. We've got work to do on the portfolio. We're in too many assets, many of which are not generating the sorts of cash flow or return that we need for them to be part of the long term of the group. So we've got work to do on the portfolio. We need to sharpen our capital discipline and make sure every dollar that we're spending is making an impact on the bottom line. And then we've got work to do on improving the overall consistency of our operational performance and strengthening the culture. So we've got that laser focus on performance and accountability. These are the things that will help deliver a step change in performance for BP.
Okay, so still a lot to do on a number of agenda points that you just set out there, Meg. When it comes to being fit for growth, what will that growth look like, and when will we be ready to see the growth phase at BP?
Well, actually, a lot of that growth is already underway. So when we look across our upstream, we've got very high-quality assets in the U.S., both onshore and offshore. We've got two very significant capital projects underway in the Gulf of America as we speak. Production from those fields, those developments, will be online in 2029 and 2030. We've got additional developments in the gas business in places like Indonesia and Trinidad and Tobago. Again, those are starting to come to fruition. We've got an opportunity in Venezuela, and we're looking at additional opportunities in Venezuela. And then we've got a very significant discovery that we made in 2025 offshore Brazil. Now, we'll be appraising that opportunity or that discovery later this year, early next year, with the intention to be bringing that forward. So we've got this nice cadence of growth opportunities that will be bringing new production into the group, starting 2028 and stepping forward from there.
Okay, and Meg, thinking about the asset sales, you said just in the last few days that BP is going to be putting up its North Sea assets up for sale. What has motivated that decision, and is there anything that the current UK government can do to change your view?
Yeah, that's a decision that was not made lightly. The North Sea has been part of BP's history for more than 50 years. And the rock quality is still good. We still think there is untapped oil and gas potential in the basin. But when we are really rigorous and we look at the data and we ask ourselves about free cash flow generation, return on investment, resilience through a low price scenario, and we look at the UK North Sea, it just is not competitive within our portfolio. Now, that said, we've had plenty of companies come knocking at our door, expressing interest in buying the assets. So I am confident that the fields will continue to be well managed in other hands. But it's simply a question around capital discipline and capital allocation within BP.
So would you say this was unconnected to UK government policy around the North Sea?
Look, UK government policy hasn't helped. So if we look back over time, the last 20 years, there have been a series of interventions that changed the tax rate, changed the regulatory environment. There's points where you can explore, there's points where you can't. And one of the things I tell governments all around the world is when we think about our investment decisions, where we're going to spend money and generate return for 20 to 30 years, we want to have certainty that the fiscal terms are not going to change. So I have spoken with the Prime Minister. I've given him these same messages. I've said, look, there's an opportunity, to be really pragmatic, to help ensure that we're taking care of those jobs in Aberdeen, to make sure that the North Sea plays a role in helping meet the UK's energy security. So hopefully we'll see some good things from this new government.
Meg, can I ask about the parts of the business that seem to have done very well? So refining, trading businesses, both booming in recent months, of course. How would you evaluate the contribution that the trading business makes to the underlying BP business, and how repeatable it is?
Yeah, so the trading performance is quite variable quarter on and quarter out. But one of the things that we've done is look back over time. So over the past 6 years, the contribution of trading has been a 4% uplift on return on capital employed across the group. So whilst individual quarters will be quite variable and it will depend a bit on market circumstances and the volatility that we're seeing in commodity prices, which obviously has been quite high in this past quarter, the reality is the trading team delivers sustainable benefit over a long period of time, and that's why it's such an important part of the BP group.
Yeah, and refining margins have also been strong in recent months, of course. Do you see that as something that is sustainable, Meg, or is that also connected to recent geopolitics?
Yeah, we're very pleased with the performance of our refining assets today. As I said, 1.5 million barrels of oil processed through them. I'm also really pleased to see the adaptability. So, for example, as this global energy crisis has been rolling out, we've been able to adjust our refinery runs to help produce more of the products that consumers need. For example, in April, May, we were starting to see some signs of pressure on jet fuel. We adapted our refining runs to produce more jet. And our global trading business has allowed us to take the products to the places in the world where they're needed most. For example, we've shipped diesel from the west coast of the U.S. down to Australia to help meet their needs and the needs of those customers. Look, we're very focused in refining on making sure that we have that safe, reliable, cost-efficient production to ensure that we can help meet consumer needs at this point in time where there's market tightness.
You've made an announcement this morning, Meg, about other asset sales. What is crucial for you when you decide to sell or to keep an asset? What are the key criteria you're looking at there?
Yeah, look, with any asset decision, we need to step back. We need to be unemotional. And the North Sea is another example of that. We need to step back and we need to look at the numbers and ask ourselves, what's the capacity of the business to generate free cash flow? What sort of returns can we get if we continue to invest in this business? What's the growth potential? What's its resilience to price shocks? So we look at all of those dimensions, strategic fit, but we look at all those dimensions and we make decisions based on the numbers. Right now, our portfolio is too big and too spread, and we've got to get more focused. And the announcements we've made recently, reflect that intention to focus, to really focus the business, drive performance, and be ready for growth.
Meg, thank you very much. Thanks so much for joining us. Really good to speak to you. Meg O'Neill, the CEO of BP. So really interesting conversation there, Lizzy, with Meg O'Neill. First time we're getting to speak to her on earnings day, of course. She's only been in the job months, taking over in the CEO seat. It's been a business that she's leaning into the transformation of, as we've been discussing, cutting costs, selling assets, reducing debt, and clearly a big focus still on getting the balance sheet back to where she wants it to be, so that then, after, at some date in the future, there can be more focus on growth.
Yes, indeed. Well, let's turn to what else you need to know this morning. The Rhine River's water level has fallen to its lowest since records began in 1880 as hot, dry weather continues across Europe. At the key shipping point of Kaup in Germany, water levels have dropped to just 24 centimetres, raising the risk of disruption to the transport of coal, fuel and other industrial goods along one of Europe's busiest waterways. Elsewhere, Coatue Management's hedge fund plunged more than 8% last month, the latest tech-focused money manager to be hit after a sharp sell-off in AI stocks. The loss marks the worst month for Philippe Lafonte's fund in more than a year, although sources say the fund is still up over 14% so far this year. Meanwhile, Bloomberg understands that multi-strategy hedge fund giant Millennium also suffered from the sell-off, losing just over 2% last month. And the yen has posted its first drop in 5 days as the impact of the latest intervention by authorities starts to fade amid debate over its sustainability. Japan's historic joint intervention with the US is shifting market focus to whether the yen can strengthen beyond 155 per dollar, a threshold strategists view as the key test for the rally's staying power. Well, we continue to watch out for more intervention, and we talked a lot yesterday about how it all it seems we need to wait for the BOJ to step in with hikes to kind of put a floor under yen weakness. But it's interesting that market pricing has changed somewhat since last week. So I think it's about a 50-50 chance of a September hike now, up from about 30% a week ago.
Right, yeah, we were hearing from one of our colleagues just yesterday, September is now live. We had one dissent at the BOJ, I think, last week, didn't we? And increasingly the market is thinking, given what we've heard from the Finance Ministry, that maybe, yes, all these meetings are now going to be considered live, which is quite an interesting development. Coming up then on the programme, as Asia stocks diverge from Wall Street's tech-led rally, we will look at the risks ahead for the global economy. Chris Watling is with us, Longview Economics, also thinking about where borrowing costs go, where Treasury yields go. He thinks we could get to 6% on the US 10-year in the medium term. We'll get into that conversation shortly. This is Bloomberg. Welcome back to the opening trade, 7:30 here in London, 30 minutes then until we get the opening cash trade for this Tuesday morning. Let's look at the futures picture. Pretty positive, actually. US futures pointing higher. The US focused yesterday on the hyperscalers returning, not too sidetracked by weakness in chip stocks. That chip stock story, though, is dominant in Asia, and so the Asia session looks a little underwhelming by comparison. But it looks as if that, adding in the European earnings picture we've had out this morning, Lizzy, has us set up for a positive start to trade.
Yeah, in the bond space, there's not much doing this morning, unfortunately. When it comes to treasuries, yields are a touch higher. Here in Europe, we're pretty steady across the curve, across the continent. And in fact, yields are lower on the 10-year in Spain and just not even moving when it comes to Germany and France at the front end of the curve. But our next guest actually sees the US 10-year going to 6%. So let's turn to him now. We've got Longview Economics global economist and chief market strategist Chris Watling with us round the desk. Chris, what's going to take us there? Because we're nowhere near there yet. 4.68% is where we are on the 10-year.
Yeah, well, I mean, if you think about the 10-year in the States, it's kind of gone sideways for 3 years, and we've been bouncing around this range in the fours pretty much. I mean, sort of touching a little bit below 4 at one point and so on. But what gets it there? Well, if you look at the US economy now, it's broadening. We've got this capex boom. There's debates about whether the stock market's in a bubble and what that'll lead to. But actually, the economy's broadening, the credit cycle's coming through. It looks like the labour market's starting to turn up gently. And you're getting a good industrial cycle. We saw that with ISM manufacturing yesterday.
We did,
so if you get that momentum, economies start having a life of their own. And they start having positive feedback loops. And that's the sort of thing I think that will get you up towards, look, whether it's 5.5, 6 and a quarter, I don't really know. I don't think anyone knows. The point is you're going to break out of that trading range and move to the upside. We've moved into that phase of the economic cycle where it's becoming self-sustaining.
Well, the S&P is kind of in a range at the moment, isn't it? It's plateaued somewhat. You've described its recent performance as a beautiful consolidation.
Yes, yeah.
Is it just, healthy that this is happening, or is it the start of something worse, a bigger correction?
Well, I think it was extremely healthy. You came into May, June, it looked really troubling, this market. It was very speculative. Stocks have gone up, like Intel have gone up 150% in not many weeks. And there was this real concern this market was maybe getting really frothy and toppy and troubling. And that's why I called it a beautiful consolidation, because whilst we've unwound that excess in some of those sectors, or some of the excess, Korea is the case in point, but semis in general, the market as a whole has gone sideways, as you see from the charts. Since mid-May, flat as a pancake. And all the sort of actions under the surface as there's been rotation and churn. I liken it to a duck. On the surface, a duck looks serene as it glides across, but underneath it's paddling like mad and this is kind of what's going on in terms of the sector rotation.
Yeah, and so do you want to lean into that sector rotation? Is that a smart thing to be doing, Chris? We've just come through an earnings season where we heard from a lot of the big tech players in the US, and even within the hyperscalers, it seems anything to do with cloud, you're okay to spend AI investment capex on things to do with cloud. And if you've got revenues attached, that's okay. The market doesn't mind that. But if you overspend on capex and you don't have those revenues, then you get punished. So what are we learning about the sort of AI rollout, do you think?
Well, that's true, isn't it? There's punishment if you overspend on the capex and you raise it. We saw that with Google and one or two others. It's a very interesting earnings season. Not least the fact the earnings growth is so strong in the US. The numbers are just mind-blowing, really, in terms of the size. But I think, our approach to this market is really sort of to barbell, cyclicals and tech. And you've got to be selective. We pick countries on sector dispersion and sector strength. And that's kind of where we're looking at. I've been pushing the railroads. I think railroads are a great sort of sector to be involved in, because if the industrial cycle comes back, the volumes come back and so on. So, yeah, we've learned a lot, I think, in this earnings season. We've learned how powerful the earnings growth is. And of course, you may question how long it'll go on for, but if the US economy is genuinely broadening, it should continue.
And 6% Treasury yield, does that stop the party, or remove the punch bowl, to use whichever metaphor you like, or no, that's all good?
This is like a sort of 18, 24-month target, and it's the end of the trade, absolutely. Once you get there, that's the idea. On the way there, you're travelling, it's all good, it's telling you about more growth. As you get there, it's telling you rates are too high.
You say that the dollar's also due some weakness. The dollar had its worst week in over 3 months last week. I don't know if that's, your prophecy coming true already, but I do wonder how much of it's a sign of the credibility problem that people are pointing to emanating from Kevin Walsh at the top of the Fed.
Well, I don't know about the Kevin Walsh story. I'm not sure that's what's driving the dollar. I think, the dollar should go down for cyclical and structural reasons. Structurally, because basically Donald Trump's beating up on his allies, so he's sort of discouraging people from owning treasury assets. primarily across much of the world. And you're getting this deglobalization trade that's playing out with China, sort of creating another currency region or trying to. But cyclically as well, when the global economy is rallying, generally the dollar goes down, and that's the normal trade. So there are a lot of reasons for the dollar to be weak. And we shall see. I mean, I was looking at sterling yesterday against the dollar, now a minor currency really. But it was kind of interesting how it's held in so well in the last 12 months. Despite all the concerns about domestic politics, and the fact that concerns about the economy hasn't been that good. But the sterling's held in there as we've unwound a lot of bullish sterling positioning over the last 12 months. And I think you could make similar comments about the euro. So other currencies are suggesting that they're not the yen, but are suggesting that they want to go up.
I was going to ask you about Japan, because you said about negative treatment by the US of allies. Well, not Japan, because they're friends, and it seems that that's rewarded. What do you make of that kind of cooperation between the US and the Japanese to support the Japanese currency? Or
is it all selfish? Is it all just the vested interests of the US Treasury?
Well, I think it is entirely. I mean, country, it's like Palmerston, isn't it? No one has allies; they have interests. And that's exactly what we have here. We have a Treasury Secretary in the US who doesn't want higher Japanese bond yields because it would imply selling of US Treasuries, and he doesn't want higher Treasury yields. So I think that's what's going on. The markets are trying to adjust, then they don't want to allow it. In Japan, they probably ought to raise rates, perhaps. But yeah, I think it's convenience. It's a marriage of convenience.
How are you interpreting the UK story, just going back to that then? Because you mentioned the politics, there's also the central banking story. And, we had this hawkish vote split out of the BOE, but some people are saying, it's the doves that you need to be paying attention to here. And the likes of Ramsden talking about needing to cut if the war ends in Iran. Are we underplaying that side of the narrative?
I think they should cut. I'm amazed they haven't cut, frankly. I mean, I can see why they haven't cut because of the oil price. But this second round effects, I don't think so. This is yesterday's debate. I think where we are now as a UK economy, despite sterling holding in there, that is quite soft. Labour market's soft. Although it might be turning up, there is some evidence of that, but it's certainly been soft. There's spare capacity. There's a lot, inflation. I don't think looks like a problem in the UK. So, actually, the last thing you want to do is raise rates into an oil price shock.
I mean, but the inflation rate is above target, and oil prices are higher. Why are we confident this time, then, Chris, that we don't get those second round effects in the way that we did with the invasion of Ukraine?
Yeah, because the invasion of Ukraine came when there was so much money creation post-pandemic. It was a completely different world. People were sitting on savings. Money supply growth had been so strong. This is completely different. We're coming out of 3-4 tough years in the UK and in much of the West. So there's not a lot of money around. It's a tight situation.
Do we cling too much? I say we. I don't know who I'm talking about here. Me, maybe. Do we cling too much to the narrative of the last cycle, the last problem?
We all suffer from cognitive dissonance, don't we? We're all sort of looking backwards at the last problem.
Yeah. Worried about using the transitory word because people will laugh.
Yeah. Well, we shouldn't be doing that anymore. We need to. If you look at UK inflation ex transportation, it's under 2%. So it's below target. So you can see it's all distorted by the oil price, basically.
But is it that we're at the point where you think we can just fade some of the geopolitical headlines now? It's not just a UK thing, it's a global situation. And, maybe the storage situation is being exaggerated by the oil bulls.
Well, the tank bottom and the storage situation is a real issue. That is the one thing that gives me a lot of cause for concern, or one of the things. So that is an issue. But, of course, if you get a big spike in the oil price globally, that's ultimately deflationary, not inflationary. It's really taking money out of people's pockets. It's a tax on the consumer.
Because you don't spend on other things.
You don't spend on other things. That's the point. If you haven't got a lot of money around, you've got nothing else. You can't just sort of soak it up. You stop spending on other things. And there was a lovely article, I think, on Bloomberg today about how lights are going out across Asia because of the lack of energy. There's demand destruction from high oil prices, which wasn't so much the case in the pandemic. And people were spending till they're blue in the face, basically, because the government was giving them money.
Yes, and we'd had nothing to do for a while, hadn't we? So
exactly.
Everyone was enjoying themselves. We remember. Chris, thank you very much. Thanks so much for coming to speak to us. Chris Watling, global economist and chief market strategist at Longview Economics.
Well, tech leaders say that they're not seeing any signs of a slowdown in AI demand. Take a listen.
as we're investing, we're getting 5-year commitments from customers. We're getting these long-term commitments. And so we're out there making investments to keep being able to grow the business and try to meet customer demand. But as you say, today, demand still significantly outstrips supply, and we're trying to build and invest to keep up with what customers are asking for.
Matt Garman there, CEO of Amazon Web Services, speaking to Bloomberg. And we'll have more on AI and the latest tech earnings coming for you next. This is Bloomberg.
Welcome back, everybody. The futures picture for Europe looks pretty positive, looking ahead to a US session that looks mildly positive on E-minis, more so on Nasdaq futures. So tech very much in focus through the Asia session in not such a positive way, and in the US session in a more positive way than
Yeah,
Lizzy.
partly because we had Palantir surging in after-hours trading. This is, of course, after the software developer and military vendor posted second quarter earnings well ahead of analyst estimates. The company also raised revenue and income forecasts for the full year, describing commercial demand for its data analytics tools as, quote, otherworldly. Well, let's get more now with Bloomberg's Anthony Stevens. Anthony, what's your take on what the Palantir rebound and what's driving it means for the broader AI trade? Good morning.
Morning. It was an absolutely blowout result, right? It's just double-digit beats, a clean beat across EPS and growth and revenue, and the management basically said that they ran out of superlatives, and I think that's pretty fair. What was priced in options was a 5% kind of move after results. We are getting double that move to the upside. Now, what was very interesting was the tone of commentary around the AI kind of dynamic. They said they would be model agnostic on how they use AI, and that's a very interesting aspect of Palantir's business. They use AI to create software for its customers. So they said commercial revenue was staggering, and it'll be very interesting to see whether other software companies kind of can leverage AI in the same way. Now, this is part of an interesting short squeeze in the US, where software has really started to rebound quite well. And Palantir is a pretty significant chunk of the IGV US software ETF that has gone off on a bender in the last couple of months. So it's very interesting that software is recovering so sharply against the semiconductor trade, and it adds to the pain on the US long-short side, on the long-short investor side, on the tech trade.
That's really interesting. Yeah, dissecting semis, hyperscalers, software, all of that very much in the mix still finding its feet. Let me ask you about what to expect from SpaceX then, Anthony. We get the first report from SpaceX since the IPO, shares trading below the IPO price. I know some of our colleagues in Asia talking to an analyst were saying that SpaceX has an identity crisis. Are you clear on the identity of SpaceX and what to expect?
And that's why I was smiling as you were speaking, right? We don't know what they are going to lead with. Are they going to lead with the Starlink progress? Are they going to lead with the Starship development? Or are they going to keep talking about data centers in space and how much capex is going to be laid out for that push? And that is showing up in the implied volatility move of the stock on earnings. It's somewhere in the range of 14% after earnings as an implied move, right? So there's a lot of uncertainty going into that earnings. The capex is in the tens of billions of dollars, and what they decide to deploy that capex on. Now, it's also going to be interesting how much of that capex is being lent out in terms of compute, and how is that business doing in terms of selling compute versus the kind of steady revenue that Starlink and the launch business are getting, and how are those businesses growing. Starlink in particular has been pushed very, very hard in the developing world in terms of high-speed internet and other such kind of mechanisms. So it'll be very interesting to see how much growth they are seeing. On the other hand, we continue to want more details on the build out of these data centers in space. That is part of the reason the stock has come up so hard in recent days. It's being treated as an AI data center proxy. It's basically being treated as the world's largest neocloud. And that 43% drawdown has to be kind of stemmed for retail investors to come back into this stock and reassess the story.
OK, Anthony, thanks for your views. Really appreciate it. That's Bloomberg's Anthony Stevens.
Let's turn our attention to the markets in 3 minutes. Broaden the lens. We're joined now here on the opening trade by Adam Linton from the Markets Live team. Adam, are we still thinking about the yen this morning? I mean, to some extent, this was yesterday's real area of focus, wasn't it? But today we see the yen underperforming a little bit, and that's perhaps not what those who want a stronger yen wanted to see. So what's our latest conclusion as to whether this intervention by the Japanese and the Americans will work?
Yeah, I think when you consider the fact that we've had a couple of confirmed rounds of intervention now, which is also coordinated with the US, and we've had warnings from US Treasury Secretary Bessent, it's been particularly disappointing. I mean, even at the trough, we didn't really break through the May lows. I think the Japanese officials would have been hoping they would have got below 155. So I think when you also consider the positioning backdrop, I mean, yen shorts, they were highest since July 2024. Dollar positioning was at record highs on some measures. It's a pretty pitiful response in what we've seen. And I think, ultimately there's a couple of things at play here. One is that the BOJ just isn't playing its role. We kind of get this continued communication effort from them that they may do something at some point in the future. In a world that's price of Fed hikes, that just isn't good enough. And we saw some angst about the BOJ overnight. So that's soft 10-year JGB auction as well. So that's also front of mind. But also as well, quite simply from a geopolitical standpoint, with something out of control for Japanese officials, is that they need this war to end. They need oil prices to come lower.
Yeah, so it's kind of a waste of money on this intervention unless you get a step in from the BOJ. Just on that geopolitical point, the headlines flying around, the comments flying around, Donald Trump being pretty angry towards Iran, them saying that the talks aren't even happening. What does the market need to have greater progress?
Yeah, I mean, I think there's a pretty high bar at the moment for success. We saw Trump be relatively bullish on the prospects over the weekend. At the same time, Iran was talking with Oman about the Strait of Hormuz, but it wasn't even about the full reopening of it. And traffic through the Strait of Hormuz is still particularly low. Then in other parts of the Middle East, traffic flows are relatively low. I think, obviously we need to see Trump's bullishness over the weekend reciprocated from Iran, but we're just simply not seeing that at the moment. They're just saying that, the US needs to change its behaviour. And I think even if we do get an interim peace agreement, then I think the market's going to be particularly wary of it, given that we've already had one broken down. And then since the onset of the conflict, as far as I can tell, there's been no progress on nuclear. So I think, energy prices will stay sticky. And in that environment, upside for bonds is limited, particularly in the US, where there's a real rate story, and then also for Europe.
Yeah, let me ask you about the data point of the week, which is non-farm payrolls, due on Friday, of course, Adam. Are we concerned? I mean, last week we saw that steepener trade, partly due to the Fed narrative rather than the data, but we don't really know how the Fed is going to react to data. That's by design, Kevin Walsh has told us. So how are you thinking the market could respond then to this non-farm payrolls?
Yeah, I mean, it's a big data point. We need to play the ball, not the referee, as Kevin Walsh says. And any data point now is much higher vol event than it otherwise would have been. There's plenty of scope to reprice a September hike, only price around 65%. I think it's more interesting if we get a hot report. Do markets really ramp up these wages at the front end? I think the Fed's getting behind the curve. But also at the back end of the curve, there's a real rate story which is really driving things as well. We saw strong ISM yesterday. And if you see a strong NFP, do we start getting 30-year yields towards 5.3%, and then does that also become a cross-asset story as well?
OK, Adam, thank you for the preview. That's Adam Linton from our MLive team, and you can get up-to-date analysis and insight from the MLivers at MLIV Go on your terminal. Now let's go to our stocks to watch this morning with Chloe Melly. Chloe, Lufthansa in focus this morning.
Yes, good morning, Lizzie. Absolutely. We've got yet another airline warning of this growing uncertainty. Lufthansa has cut its capacity growth plans, and the second quarter profit was also less than half what it was last year. Of course, the airlines are all facing the same challenges. We've got those higher fuel costs, we've got that weaker consumer confidence, and then for Lufthansa in particular, there's also specifically the company-specific challenge of the strike costs. And then if we take a look right now on the board at the jet fuel prices, we saw, of course, a huge ramp up, then followed by a sharp downturn. But we are seeing it rebound once again. And so this could threaten the outlook as well going forward for that entire airline industry. So they're not out of the woods just yet. Staying in Germany and moving on to fashion, we've got the online retailer Zalando, which has also cut its guidance this morning, its revenue growth guidance, and the profit also missed estimates. We have seen the shares do pretty well so far this year. We're up about 15%, but we are seeing the shares on Tradegate this morning falling significantly. So we could see a bit of a hit at the open this morning because this signals perhaps this persistent consumer weakness that is really affecting that company. And finally, let's go back to London, where we've got BP posting its highest quarterly profit in more than 4 years. Of course, its refining and trading businesses have really benefited from this continued volatility in oil prices, this disruption in the Middle East. It was also announced this morning it is planning to sell its natural gas business, its renewable natural gas business. So it's really pushing ahead with this portfolio simplification that's really at the core of this strategy from the new CEO. We've seen BP underperform slightly at some of its peers, but we could see this boost this morning on the back of those earnings.
Chloe, thanks very much. Chloe Melly with a rundown of some of the stocks in focus. We'll add to that list with Fresenius Medical. Could that be an area of weakness? The numbers at first glance didn't look so bad. Second quarter numbers out just yesterday after hours, and they're reaffirming their outlook. But some of the pre-market moves suggest we could be a little bit weaker on that one. Also keeping an eye then, Lizzy, on SAP. We talked in detail about Palantir. Very different businesses, but they're both software, and they're both software that has in the past been considered vulnerable to AI competition, so that's an area of comparison.
Yeah, we could see some read across. Loads of other earnings that we could flag. HSBC numbers, we talked about them getting back on the buyback, raising their cost savings, a profit beat for the bank. Bayer earnings as well, beating estimates. Conti, and we're going to be talking to Continental later on in the programme, but their margin rising, having sold more premium tyres, and Hugo Boss beating estimates for second quarter EBIT as well. So loads of stocks to watch off the results this morning.
Yeah, loads of results to fold in on top of the tech narrative that we're dealing with, which does seem to be diverging a little bit between the Asia focus on chips and the US focus on software and hyperscalers. US futures then pointing higher, European futures pointing higher for all of the reasons that we talked about. We'll be back with the opening trade this Tuesday, the 4th of August. We will bring you that shortly. This is Bloomberg. Welcome back this Tuesday to the opening trade. We just have minutes to go until we get that opening trade. And the US session of yesterday, a little instructive as to where we head, but not a huge amount. So after we closed up here in Europe, we saw a slow drift slightly higher on US stocks. So perhaps the backdrop was set for something a little positive to bounce off this morning. And we add in on top of that, we layer in on top of that the earnings stories that we've had out here in Europe. And it does seem as if we will then get a positive start to the European trading day. The tech story across Asia to the US does seem to be diverging slightly, but globally then we do see stocks not far from all-time highs, certainly on the S&P yesterday that was the case, nearly taking out those all-time highs, and certainly on the global stocks narrative that is the case as well. So we continue to follow the AI story and everything it delivers. The futures picture then, all things considered, looking pretty positive this morning, Lizzy, for European equity markets.
Well, when it comes to the stocks to watch, Anna, it's all about earnings really. A couple of big names in London reporting this morning. HSBC and BP are two of them. We've spoken to both of their CEOs. You were speaking to Meg O'Neill at BP. She says that the company is getting fit to grow, but there's still work to do on the transition. But already the company reporting profits surging because of the oil trading and refining boom, of course, because of the Middle East war. HSBC, meanwhile, we spoke to George Eldhary, a conversation with Francine. They've resumed their buyback up to $1 billion in stock. They've increased their cost-cutting target, and this is all after their second quarter pre-tax profit topped estimates. Just finally, let me add on, out of Germany, Lufthansa, they've actually warned of a profit risk because of the jet fuel surge that's really roiled the whole industry of airline. So 3 stocks to watch there as we get towards the open, Anna.
Yeah, and we'll add in Zalando as well, because that did seem to be an area where they've refined their guidance, they said, but the market taking that quite negatively. We'll watch that one as well at the start of trade. So a few companies in Germany then, where we're going to be focused on how they perform on the back of their numbers. Continental is one of those as well. We'll be speaking to the management team over at that business a little bit later on in the programme. But in the meantime, how do these European equity markets more broadly open up? Well, the FTSE 100 out of the gates and to the upside, up by 0.2%. No, perhaps not. Finding its feet a little bit this morning. But we had some heavyweights in London reporting with HSBC, the largest listed company on the FTSE 100, of course, and we've got BP numbers out as well. So all of that being digested by these markets, and we do see the FTSE then bouncing a little bit down, bouncing by around 0.3% this morning. The IBEX is just slightly positive. The CAC 40 up by 0.3%. The divergence we're seeing in the tech narrative, interesting to see if any of that plays out in European stocks. Yesterday in the US, we saw hyperscalers doing OK. We also saw software doing OK, and certainly after hours with those Palantir numbers, Lizzy, that was part of the story as well. In the Asia session, things looking a little more lacklustre, so we'll see which of those stories sticks to the European trading day. What are you seeing in the sectors?
Well, if we break it down, the best performer is basic resources at 1.8%. Industrial goods and services not far behind, but you flagged tech if we were going to see a read across from the US session. Indeed, tech coming in at third place, up 0.8%. But it's an even split pretty much between winners and losers this morning sectorally. Bottom of the basket, food, beverages and tobacco. But if we turn to some of those individual earnings stories that we were flagging, HSBC, despite all of that positivity out of the interview we had with the CEO, despite all of the positive news on the buybacks and increasing the cost-cutting target, the pre-tax profit beat, in fact, the shares in London are down 1.3% at the moment. So following the losses that we'd seen in the Hong Kong session, BP shares also a touch lower, only down 0.1%. But, you know, we'd seen a profit surge from BP. So disappointing result initially, perhaps, just the market reaction to those numbers. We're waiting for Zalando. We're waiting for Lufthansa. Bayer shares up more than 3% after their earnings beat. And just the other couple that I was flagging, Conti up 0.7%, their margin rising, and Hugo Boss shares up 0.2%, their EBIT beating estimates for the second quarter.
And basic resources, maybe you mentioned this one then, Lizzy, best performing sector, and that seems to be across the board, things like Antofagasta, Anglo American going higher. I mean, not bad performance by the FTSE to be able to be up by 0.4% when your heaviest weighted or your largest cap stock, HSBC, is down by 1.2%. But I do note we are seeing a bit of a bounce in AstraZeneca this morning, up by 2.3%. And of course, that was an area of weakness yesterday. So perhaps that is something to keep in mind. Let us broaden our focus and think about where we head. What have we learned through the earnings season and where do we head next? Let's speak to Louise Dudley, Global Equities Portfolio Manager at Federated Hermes, on set with us this Tuesday morning. Louise, good morning.
Good morning.
So the earnings season then, we went in, it seems, with quite high expectations for European earnings, and perhaps they've been met or even exceeded. What have you taken away so far from the earnings story?
Yeah, I think with Europe, we came in with lower expectations compared to the US. So I think it's been an easier beating environment. They haven't beat at the levels that we've seen in the US. That has been exceptional. But there's certainly been some good surprises out there. As we've seen today with HSBC, people are still kind of penalising, if everything's not perfect. And so to a certain extent, there's a little bit of scrutiny. We knew kind of coming into it as well, there was going to be a lot more focus on the outlook than what they were delivering, because obviously we've got a lot more information than what we had a quarter ago in terms of the war, how companies are faring. And so I think that outlook, and obviously starting to look into next year as well.
Technology is still your biggest overweight, including everything that's related to AI. And so when it comes to that AI trade, are you short-term picking between some of the areas of tech that are going to benefit from AI, or are you just saying, look, this whole theme is so strong, we're just going to lean into the whole thing and ride the waves?
I think at the moment, the areas obviously that are seeing kind of the strongest returns, strongest earnings are those that have constrained supply, and so therefore have that pricing power. So more on the hardware memory side, and certainly kind of avoiding most of software other than the cyber type names. But I think for those names, we're continuing to see CapEx being increased. So at the moment, we're still, I think, away from what people are worried about, which is obviously when it starts to tip. So we're very kind of focused on, if we start to see that happen, very focused on historical bubbles and what that means and things like that. But actually, for now, I think everything's keep going in the right direction. And actually, we are starting to see some kind of green shoots in terms of the actual kind of build out and the usage case, which is maybe stronger than people were worried about maybe a couple of months ago.
Well, yeah, how do you play the tech story geographically? Because, of course, there's been such a spotlight on the Kospi and the Korean tech story. Loads of retail investors frankly traumatised by their experiences on the Kospi. Is that volatility a signal of something bigger to you?
So I think a lot of that was driven by retail investors, and I think those recent flows, again, that kind of sell-off was actually those retail investors as well. We know that they were obviously highly levered, and so we expected maybe some of that volatility. We do have exposure within the region, but to a certain extent, we're also diversified within that as well. But we have seen, we continue to see those Korean companies as being huge beneficiaries, and I think that will kind of have benefits through the Korean economy as well.
So do you buy dips on the Kospi then?
We haven't been buying dips, but I'd say we have a substantial position.
Okay.
So that's the AI focus. I mean, how are you playing Europe when it comes to AI? Are you thinking of some of the capital goods companies that supply the AI story? Are you thinking of chip makers? What's the European trade?
Yeah, both of those. So I think some of the largest names actually are the ones that continue to do well. Obviously, those that have good relationships across the US and also with Asia as well. We know that kind of China for ASML was weak. But to a certain extent, they are still very well positioned within, what they do. I'd say the other area of strength that we're seeing that, we like within Europe is the financials. And obviously that's, been very strong, but actually we continue to see that as being a strong area.
And is that a rates trade?
It's a little bit of rates trade, but it's also just, maybe where do we see value within Europe, and those are the areas, rather than some of the other kind of very out of favour chemicals companies, for instance.
How are you thinking about the geopolitical risk? I'm looking at the Lufthansa share price this morning, down 7%. I think it was down about 9% earlier on at the start of the session, off the back of its results, which, of course, come back to the jet fuel component here. More broadly, do you just try to fade out the geopolitical risk at this point, with all the headlines that go back and forth and don't seem to add up from both sides?
Yeah, it does seem like, what is the longer term trajectory, and I think we can benefit from being those longer term holders and taking advantage of some of those kind of moves. I think on energy we are broadly neutral, because we know that the underlying earnings of those companies are going to continue to do well. Because the energy price, the oil price, will be sustained at a higher rate, through this year.
So does that mean on the flip side that you continue to be negative on airlines?
Yes.
Right.
Yes.
And what about pricing power, Louise? How important is that this earnings season? Has that been something of a theme? I was drawn to the number. We're talking to Continental a little bit later on, and they're reporting better margins, and partly that's because they're selling some of their higher end products, if that's the right phrase. I mean, is pricing power something that's setting companies apart from each other in this earnings season for Europe?
I think it is, but it's also what we've seen within companies is that, their product mix and where they're focusing is also making a big difference. And certainly, the amount of companies that have a diversified business and then suddenly there's this AI part of their business that's suddenly doing very well. And so I think that's a little bit of the story that's holding up some of the weaker areas for some of those more diversified companies.
Just looking at the FTSE today, so we're up, I suppose partly it's that Astra boost that you mentioned, Anna. It's also oil higher, $84 a barrel on Brent this morning, up 0.9%. Does this FTSE rally have further to run, do you think?
So I'd say we do have exposure, we're overweight within the UK, and I think, it is some of those larger names, and we do have more of an underweight to some of the energy names. But yeah, I think, relative to Europe, things are looking reasonable. I think the latest kind of data out of the UK from a kind of macro perspective was stronger than people expected, and inflation seems to be okay. So I think that's the thing that everybody is very worried about. Obviously, we have a lot of uncertainty in terms of Burnham and that outlook and where that comes from, and obviously we don't want any big jolts or anything, but hopefully maybe with the recent lessons maybe we won't get that. So hopefully it will be kind of a steady ship through this year.
And Louise, how do you think about momentum and those momentum trades? Because they've done the chip stock momentum was extraordinary until it wasn't anymore, and then it was very much out of favour. Do you lean into that kind of momentum, or are you not chasing that?
So we do certainly have a momentum tilt within the portfolio, but at the same time we're always looking to kind of diversify that and kind of hedge that to a certain extent. Healthcare is one sector that we're kind of looking at particularly because it has those more kind of defensive type characteristics. It's obviously been kind of underweight this year. So that's an area, for instance, that we're looking at, as well as that kind of real estate continues to do okay. We know it's interest rate sensitive, so there are opportunities on the days when people are feeling better about inflation, and so those are the kind of opportunistic trades which are kind of balancing the portfolio in terms of some of that kind of more concentrated momentum together with those underlying more quality, profitable kind of companies.
Okay, Louise, great to have you with us. Louise Dudley there, Global Equities Portfolio Manager at Federated Hermes. Thank you very much. Well, let's check in on the core six, shall we? This morning, we have a few names actually up more than 2%. So Novo, Rheinmetall, ASML, Schneider. But the ones that are in the red this morning are LVMH and Nestle. So let's get more of a view on some of the individual stocks that are moving this morning with Chloe Melly. Chloe, Zalando was expected to be down in double digits. It seems that's playing out for you.
Yes, absolutely. Good morning, Lizzie. We are seeing Zalando down almost 15% this morning after those disappointing second quarter numbers and the expectation of revenue coming in at the lower end of this guidance range. And analysts have noted that this was driven by particular weakness in sneaker sales. So that seems to be the thing that has really weighed down the performance for Zalando. And we are seeing a huge hit this morning for that company. We are also in the red for the airline Lufthansa after it warned of a growing uncertainty and profit risk because of course, those higher fuel costs. And it's also been dealing with those strike-related costs after the walkouts from pilots earlier this year. And we're down quite significantly as well this morning, about 8% this morning. Moving on to HSBC, which is also seeing some weakness. It resumed its buyback. It had a profit that was, it's actually back in the green now. It was in the red originally, and but it has resumed it buyback. It has profit that beat estimates. It also has improved its cost-cutting target. This was not enough to sustain this really impressive rally in Hong Kong trading, but it seems that now it is getting back in the green for HSBC. Moving on to Fresenius Medical Care, which is also, has seen a bit of weakness this morning. We're down about 5%. There's been persistent weakness in treatment growth, which is really at the core of this long-term strategy for Fresenius, which explains some of that weakness then this morning. Moving on to BE Semi, which is up this morning after being upgraded by Berenberg, and the analysts saying that there was some weakness in the shares recently, a real pullback that now creates an opportunity to buy that stock. And so we're up about 4.5% on the back of that. And finally, let's end with another positive mover. We've got Bayer posting an unexpected increase in revenue, and that was driven in particular by the crop science business, and that is driving the shares this morning. We're up about 4% for Bayer.
Chloe, thank you. Chloe Melly with those stocks. There's plenty on the move this morning. One of those then is BP. As BP posts its best quarterly profits in 4 years, we'll bring you some highlights from our interview with the CEO Meg O'Neill. We'll get some analysis from the Bloomberg News team as well. This is Bloomberg.
There are significant areas for improvement. The balance sheet is first and foremost an area of challenge. We're carrying financial liabilities when compared to the size of the corporation that are just too high. So we've got to strengthen the balance sheet. We've got work to do on the portfolio. We're in too many assets, many of which are not generating the sorts of cash flow or return that we need for them to be part of the long term of the group. So we've got work to do on the portfolio. We need to sharpen our capital discipline and make sure every dollar that we're spending is making an impact on the bottom line.
That was part of my conversation earlier with the BP CEO, Meg O'Neill. Let's have a look at how this is going down with investors then. The BP report out this morning, sending shares up by 0.8%, outperforming the wider FTSE by, well, not much, but sort of on par with the FTSE. This after BP posted its strongest quarterly profit in more than 4 years, as the oil major saw its refining and trading businesses boom amid rising energy prices. Let's bring in Bloomberg European oil reporter Mitchell Furman with us on set this morning. Mitch, very nice to speak to you. So what stood out to you from looking at the earnings report and all of the detail in there? Because from my conversation, we just heard that clip, she's still very much focused in the here and now on transition, which is about the balance sheet and the portfolio.
Yeah, it's about the turnaround story. BP put another key asset up for sale, their Archaea Energy biogas business, which BP purchased in 2022 for $4.1 billion. And BP said it will reach its net debt target range of 14 to 18 billion sooner than expected later this year, which is on the back of these financial tailwinds that you laid out from this quarter. So, Meg O'Neill, the new CEO, she just took over in April. She's trying to kind of step up this turnaround story.
So she called that turnaround getting fit to grow. Part of that, she said, was sharpening capital discipline. And part of that, she says, includes the North Sea oil business sale. Anna pressed her on what this was to do with and, the political implications and potential causes for it. She said government policy hasn't helped. Do you think that it's too little too late from Andy Burnham? She says she's actually talked to the Prime Minister about the sale of this business.
Yeah, BP is the last remaining big oil global supermajor with its own North Sea business. So clearly all of BP's rivals see the North Sea as uneconomic and not viable in their portfolios. So now with BP having a new CEO and taking a fresh look at the business, she may not have these sort of these long-term, dated back commitments to the North Sea. And as she laid out earlier to us, and she's been saying this pretty consistently since taking over, that BP's projects need to compete within the context of its own portfolio, not necessarily geographically. And so it's about reaching a certain returns threshold.
And in terms of the things that have really been delivering for this business, the trading part of the business, that once again proving to be very useful. The refining part of the business, refining margins have been surging. I suppose the concern, Mitch, is there amongst investors, is there a concern that maybe these things are just very attached to the higher oil price, to the volatility we've seen in oil prices as a result of developments in the Middle East, and that could go away?
And that's a challenge that Meg really hit on this morning in the earnings statement. She talked about how BP needs to kind of hardwire its accountability and cost base. They need to hold themselves accountable to a higher standard, and that essentially, in recent years, BP has failed to meet its potential, and now she's trying to kind of hold the whole breadth of the company accountable so they can make the kind of right decisions to achieve those targets.
OK, great to get your analysis, Mitch. Thank you so much. That's been Mo's Mitchell Furman. Well, turning to some other earnings out of London this morning, HSBC announcing a fresh $1 billion stock buyback and raising its cost-cutting target as it reported second quarter earnings that beat estimates. The CEO, Georges Eldaheri, spoke to Francine Lacroix in an exclusive conversation earlier this morning.
What I'm really focused on is delivering for the business, focused on all the growth opportunities that we're driving for the business, delivering the strategy and the simplification at pace, and the upgrades we have shown in our capability to do so and the speed at which we are able to do it safely are a good testament of the capacity we're creating to invest even further in the business.
Do you think a possible UK tax on banks is a possibility?
Look, that's a matter for the government. What we're really focused on is supporting the government and the government's intention to support growth in the UK. Now, if you want to achieve growth in the UK, you need businesses that are investing. You need confidence. For businesses to invest, they need to be able to access financing. For them to be able to access financing, they need a strong, well-capitalized banking sector to support them. So our role, UK is extremely important for HSBC, it's a home market. Our role is to support all businesses across the UK. We support around 700,000 SMEs in the UK, across the UK. And we've grown our lending to them 12%. We've grown our lending to all business in the UK about 10% or $10 billion US. We already pledged another £5 billion of investments to support SMEs in the UK. All of that is what is supporting, or hopefully supporting, that growth that we wish for the UK.
So another view there from a major UK CEO on the Burnham administration. Let's get more on the broader earnings there from HSBC with Bloomberg's Tom Metcalf, who leads our European banking coverage. Tom, the share price reaction was initially negative, then it went positive, and now it's back flat to the downside for HSBC. I did wonder if a little spike in it came from Elderi saying on the call with media that the bonus pool is going to be hiked if performance keeps up. What are the key lines for you from these earnings?
Yeah, I mean, I think that share price sort of move just shows that they're kind of mixed, right? They have beaten on quite a few of these estimates. But, on the converse, you could say, it's not really kind of core earnings that have been boosting that. And, there's a little bit of sort of cost guidance, around the bonus point, basically, which might have sort of, spooked some investors. But broadly speaking, they're executing on their strategy. As we just heard then, they're kind of, full steam ahead on that. There's no deviation. And it just sort of feels they're kind of, rolling through quarter on quarter. They've now absorbed Hang Seng effectively. No sort of nasty surprises in this set of earnings, at least.
Yeah, I thought it was really interesting what they said about AI, about how Elderi said he's personally looking at token costs, which I think is great. Maybe you've got CEOs all over the world sort of tracking what they're spending on tokens all the time. And that area of cost concern layered on top of the bonus pool cost concern, then, is that adding up to something a little worrying for investors?
Yeah, well, I think that's probably, if you're looking for something to take away, on the downside, it would probably be that sense. And I agree, it's totally fascinating to hear a CEO say, hey, that's now a line item that I specifically, I think he said, sort of individually look at. And it's kind of a whole thing of all these banks, just how much are they having to spend and how well are they spending it, right? Because you can easily spend a bunch on AI, but it's just sort of how they're actually seeing any returns on that. I wouldn't expect the shares to do too much more today. They've been open in Hong Kong for a while, obviously just opened in London. And broadly speaking, it's probably, everyone looking ahead now to the third quarter, fourth quarter, and no nasty surprises so far.
And you heard Elderi's take there on, the possibility of a new UK bank tax under the Burnham government. What's the general feeling out there about whether banks are preparing for this in London?
Yeah, it was very considered words right there. He clearly wasn't look to make enemies in number 10, saying, look, that's a matter for the government. But certainly all bankers out there, they do not want any kind of extra bank tax. They feel they're very, highly taxed at the moment. And as he was pointing out, and this was sort of echoes from the Rachel Reeves era, how they've tried to manage that with the Labour government is by going, look, don't tax us more because it enables us to then, invest more in the UK, support more SMEs, as Elderi was just saying. So it sounds like they're just going to continue that messaging. But of course, someone new in number 10, someone new in number 11, it's like, does that message land as well and clearly as it did with Rachel Reeves?
Yeah, we certainly asked Nat West and Lloyds about that last week, didn't we? And everyone getting their chance to get their views across. A bit of disappointment maybe on the buyback, may underwhelm, seems to be the view from some. I think there's a Jefferies analyst saying that the buyback may underwhelm. I mean, this is a business that's been in transition and restructuring, and part of that to deliver these buybacks.
No, exactly. As I say, they bought Hang Seng, so they had said previously, look, we had to pause them for a while, so they're coming back. And it's always the way, right? Like, $1 billion sounds great, but, it's kind of what are people expecting for a bank the size of HSBC? They're certainly, known for being quite conservative on that front. And although the CFO was saying, look, buybacks are our favourite way of returning capital, I think if you were sort of, really bullish on HSBC, you kind of want to see a little bit more there. But, certainly it was a buyback's a buyback, I suppose, as well.
Tom, thank you very much. Thanks for joining us. Bloomberg's Tom Metcalf with the latest on the HSBC earnings, 8:26 here in London. When we come back, we will check in on the outlook for bond markets. We'll talk to Miles Bradshaw from JP Morgan Asset Management. That's next. This is Bloomberg. This is the opening trade, 30 minutes into Tuesday's session, and you join us on a day where we have positivity across these European equity markets, up by 0.7% on the euro, on the Stoxx 600 this morning. And actually, there's some complexity beneath the hood, which, Lizzy, I know you'll get to in just a moment. On the Tetra DAX, technology perhaps to the fore. We've had a positive session in the US on the tech front. Those numbers from Palantir, ahead of those numbers from SpaceX, all of that adding up to something pretty positive after hours in the US. And so technology stocks on the DAX are positive, despite the fact that some of the retail whale names, Zalando in particular, is a weak spot over on the German market. The FTSE 100 also being dragged in a couple of different directions. Some of the mega caps that we've heard from in terms of earnings reports this morning not setting the pace, and actually basic resources, the best performing sector across European markets, and that plays well for the FTSE 100. So a kind of mixed picture under the hood, Lizzy, but overall making some substantial gains across European stocks.
Yeah, and there's breadth to it. If you look at the ratio of members higher and lower this morning, significantly more when it comes to the gainers on the Stock 600 this morning, but not so much volume. If we look at the leaders and laggards today, Bayer is one of them. We've had a raft of earnings already, but their earnings beating estimates. Crop science strength seems to be the reason for that. We're also seeing BE Semiconductor upgraded at Berenberg, so those shares up more than 4%. And Segro is up. We've seen Prologis agreeing to final terms for a £14 billion takeover of this business, so those shares up 1% nearly. Flipping over to the laggards, though, and we've talked about Zalando several times. We saw it on TradeGate. It's played out in the actual session, down 17%. Sneaker sales missing there, so that affecting this European retailer. In Germany as well, Lufthansa shares down 8.8%. Jet fuel still a problem for the airline industry, and that hurting profits for that airline. And Fresenius Medical is the other one that we've got in focus after results. Those shares down 4.9%, Anna.
Lizzy, let's take a look at some of the other stories we're tracking this morning. SpaceX is set to report its first ever quarterly results after the close today, the first ever as a listed company following the company's blockbuster IPO this summer that raised roughly $86 billion. The stock has underwhelmed since the powerful rally in its first few days of trade. Analysts are likely to press CEO Elon Musk on the company's progress of its high-spending AI and Starship rocket projects. The yen has posted its first drop in 5 days as the impact of the latest intervention by authorities starts to fade amid debate over its sustainability. Japan's historic joint intervention with the United States is shifting market focus to whether the yen can strengthen beyond 155 per dollar, a threshold strategist view as the key test for the rally's staying power. And President Donald Trump says his latest offer of talks is a last chance for Iran after he called off what he said was a major attack on the Islamic Republic that he had apparently planned for the weekend. Tehran has denied negotiations with Washington, but says talks with Oman to get more ships through the Strait of Hormuz are making progress. Let's get an update on developments in the Middle East then, and bring in Bloomberg's Abir Abu Omar, who's in Dubai. Abir, bring us up to date, because it seems, yes, we've had these comments from President Trump with a last chance for Iran, but aside from that, a lot of the narrative seems to be disagreement around whether talks are actually taking place, the same as we've been seeing in recent weeks.
Yeah, good morning, Anna. I mean, just like you were just talking about when it comes to oil and these wider negotiations, it depends really on who you talk about. When you talk to President Trump, he says that the talks are ongoing despite the denial from Iran. When you talk to the Iranians, they say that there is no active discussion happening with the United States. They've maintained the line, Anna, just to be sure, that talks can happen through mediators, through delegates, but no active discussions between Iranian mediators and U.S. officials are taking place. Now, other negotiations are taking place, and we've reported that last week and into the beginning of this week. And those are happening between Iran and Oman, mainly on securing a line or a pathway in the Strait of Hormuz to get a trickle or a bigger trickle of movement of ships and vessels through the Strait of Hormuz. And that is really about opening up a middle pathway, one that hasn't been used throughout the course of this war, to get more vessels to be able to make their movements through the waterway. Now, those talks, we understand, are still ongoing. There's no tangible progress so far. We understand that they are in final stages, Anna, but the exact intricacies of those negotiations, we're just not sure about what is exactly being discussed. And then when it comes to the wider negotiations, of course, a stark denial from Iran on whether they're happening. President Trump maintains that they are happening. So wait and see mode yet again here in the Middle East.
OK, Abir, thanks for the update. That's Bloomberg's Abir Abu Omar as we look at Brent trading just shy of $85 a barrel. Well, let's bring in Miles Bradshaw for the bond market perspective here, head of global aggregate bonds at JP Morgan Asset Management. He joins us around the desk. Good to see you, Miles.
Morning.
So when it comes to positioning around the geopolitics, from a bond market perspective, is it simply best to assume that we're just going to have higher oil prices for a while here? How do you handle all these headlines and all the volatility?
I think a lot of it is you have to ask yourself what is priced into the market. We don't know how this conflict is going to resolve itself. It seems that it's not going to be escalating to the sort of the intensity of the conflict we saw in March. But how it resolves itself, how quickly, is unclear. Now, if you look at the market, if you look at what the market has done since June, yields are up about 20 basis points pretty much across the world. All of that has been in real yields. It's not inflation expectations. So while the oil price went up in July, it's not feeding through particularly into higher long-term inflation expectations. And I think broadly speaking, what the market is doing is giving you a risk premium for a lot of the uncertainties. The oil crisis is one, the inflation, the Fed's reaction function. There's a list of things we could talk about. And unless those risks materialise, then I think the market should stay in its trading range, which broadly speaking has been 3.75% to 4.75% over the last 3 years. And we're at the top of that range now.
You just wonder if that's too optimistic, because if you listen to the rhetoric from President Trump, he was threatening strikes, is still threatening strikes.
Yeah.
The worst since World War II. He's talking about decapitation. And yet there's, as you say, still this optimism that this war is going to end. It wasn't because of the geopolitics, notably, but we were talking to Chris Watling earlier. He was talking about the 10-year going to 6% in the US. Is that just a far out?
I don't think the conflict needs to end. That's the point. You know, you've got the same situation in the Ukraine. There's still a conflict going on. It's not having such an impact on the European gas market. I mean, it's a terrible situation we've got, but for the markets, what matters is the price of oil and the flow of oil. And it's noteworthy that we didn't hit the highs in oil prices that analysts forecast back in March. If you'd have thought this conflict was going on, you'd have forecast that oil would be at $100+. So oil is definitely getting out. Some of it is demand is lower. Some of it is because of the electrification you've seen in China. Some of it is the release of strategic reserves. So the economy is adjusting, and I think you can see that in the earnings reports and the state of the economy. So I think what you need in order to get central banks to be raising rates is the oil price pushing higher and being the conflict becoming more intense. When I look at the market's pricing that. So there is positive skew for owning bonds in this market today.
OK, and just to go back to where Lizzy started the conversation about where yields are heading and global bond markets, then, Miles, you talked about how, yes, we've priced in more risk premium. And some people said that was to do with the Fed's reaction function and maybe a lack of clarity about how that responds. But if that's what's driving things, then why aren't inflation expectations also rising? Because if we're not sure whether the Fed is going to hike rates and limit inflation, why don't long-term inflation expectations
It's a really good question. I mean, when we look at the data, you know, you've had a number of supply-side shocks. The Fed have gone through this. It's, you know, just looking at core PCE, that's the outlier on inflation compared to a range of inflation measures such as core CPI, Dallas Trim Mean. It's the core PCE that has been accelerating. It's up about 70-odd basis points from April 25. 96-odd% of that move is down to 3% of the index. Portfolio management fees, airfares and software. So that is an element of what I want to say supply-side shocks. The portfolio management fees are about the calculation methodology. It's really a function of the stock price, and the stocks have gone up. That's drifted those fees up. So I think, firstly, that is the analytical framework to suggest that you're not having an increase in underlying core inflation. You look at the labour market wage data. You look at the state of the labour market, vacancies, quit rates. So I think what you're having is concern and a risk premium related to the supply of bonds. And some of that is the fiscal deficits. Some of that is the hyperscaler capex. I don't think it's so important, but you could argue the Bank of Japan fears that the intervention may require them to sell bonds. A lot of fear is being priced into this, the uncertainty element, rather than expectations that inflation is going to be a lot higher.
And I was going to ask you about that very thing then, about the Japanese, the read across from Japan and what they're doing there with the US Treasury now into Treasuries. Because, yes, Chris Watling, we talked to earlier on, was saying that he thinks the motivating factor here is he doesn't want the Japanese to just sell Treasuries. He wants there to be another way that they can manage what's going on with their FX. And some of the detail might suggest he's leaning into that, sort of flagging other facilities available at the Fed so they don't have to sell Treasuries. I mean, what are you thinking about that?
It's very difficult to have a clear idea what the US objective is, partly because the size of the intervention from the US side was relatively small. Selling euros to buy yen is a relatively unusual way to try and reduce the value of the dollar versus the yen. I look back at the US intervention in the Argentina peso, and that was a very political act. And my interpretation is here it's also a very political act. And it could be a lot to do with the negotiations about the FDI that Japan is going to do as part of the trade deal. And for that to work, you've got to have the yen a little bit lower. I think fundamentally, if I take a step back as an investor, this is really, to address this fundamentally, you need to address the fundamentals. And the market in Japan is clearly signaling the Bank of Japan is behind the curve in normalizing and raising interest rates. Without that, the intervention that you're going to make isn't going to fundamentally alter the value of the yen. It can slow the rate of depreciation of the yen.
And do you think the BOJ will step up the pace?
I think, well, for me, that's the clear opportunity as an investor. The market is pricing a hike every 6 months. That seems a low hurdle. The BOJ say that inflation is sustainably on target. So for me, avoiding and being underweight Japanese bonds is a good way to add alpha to a global bond benchmark.
I just want to come back to the hyperscalers, because you mentioned them earlier, and in your notes you say you have a small but growing allocation to the hyperscaler debt complex. Why? When, there's
supply. You're going to get lots of opportunities to nibble away at this. I mean, value is being created. These are fundamentally, if you look at, you have to adjust for the ratings, but you've got strong operating cash flow. So you've got a balance sheet that can delever very quickly over a couple of years. You've got forecast leverage that is about half that of the corporate bond index, about 1 times leverage. And you've got bonds that are trading at about 150 over in the 30-year sector, which is wide to some BBB names. So value is being created fundamentally. We know why value is being created, because there is a huge amount of supply coming. And I think, as with any investment strategy, you've got to manage risk. And the risk has to be you want to slowly accrete these gains. You need to do your bottom-up research properly. But we're still quite early in the hyperscaler supply story. There's still a lot to come.
Miles, thanks so much. Really good to speak to you this morning. Miles Bradshaw, Head of Global Aggregate Bonds at JP Morgan Asset Management. Coming up on the programme, the German auto parts maker, tyre maker, Continental, sees profitability rise for the second quarter. We will speak to the company's CFO to dive deeper into the results next. This is Bloomberg.
Welcome back to the opening trade. 46 minutes into today's session, and it's green across the screen for European stocks this morning. Up 0.5% on the Stock 600. Lots of earnings strands to bring you this morning. Just two really standing out to me. Zalando shares down more than 16%, having narrowed their full-year adjusted EBIT forecast. Also keeping an eye on Lufthansa. Those shares down 9.7%, Anna. They've warned of a profit risk because of the jet fuel surge. So that really affecting the broader airline industry this morning. But sectorally, very split, really. Basic resources, top of the basket, retail at the bottom, and travel and leisure not far behind.
Yeah, the basic resources trade is an interesting one, isn't it? Because we don't see a huge amount of standout performance. I mean, I suppose we've got a slightly higher gold price this morning, so that, maybe is part of it, but not a huge amount of movement on the underlying commodities, which is often the thing that sends basic resources to the top of the basket, but we're not seeing that today. So an interesting market. One of the companies that's reported today is Continental. The German manufacturer saw operating profitability improve for the second quarter as it sold more of its premium and expensive tyres. The company also highlighted that raw material costs are expected to increase substantially for the second half of the year. We're joined now by the Continental CFO, Roland Welzbacher, and really nice to have you with us, Roland. Thank you for joining us here on Bloomberg TV. Let me ask you about the overall performance of the business, because you seem to have done okay, and some analysts had gone into this earnings report wondering if we might get a profit upgrade and therefore describing your guidance as conservative. How do things look to you right now?
Good morning, Anna. I think it's a fair question given our good results in the second quarter. Adjusted EBIT came in at 570 million. That's a 35% increase year over year. Why did we not raise our guidance? Two reasons. First of all, the ongoing economic uncertainty is still weighing on the market tires volumes, actually. So we have seen tire markets being down versus prior year. We think this is going to continue in the second half. Light vehicle production was down globally in North America, in Europe, and also lately now in China. And this will not stop. Replacement markets are holding up better, but volumes are still below prior year, including also the truck business. So volumes are down, but the big game changer now from the first half into the second is the raw material cost. We have seen a lot of tailwind in the first half. In fact, that was a triple-digit euro million amount tailwind. This is not only going away, it's going to reverse now in the second half, and it's going to be a headwind in front of us, and this is the game changer. And this is why we did not raise our guidance. In fact, we confirmed our guidance today. What we expect for the tire business, however, to come out at the upper half of our guided range, whereas in sales we expect to come out slightly lower to the midpoint.
Okay, and so Roland, tell me more about this raw material cost that you're flagging in the second half of the year. Is this connected to the Middle East? How much of that higher cost is connected to oil prices and developments in the Middle East?
It's basically all connected to the ongoing crisis in the Middle East. We said earlier it's going to be a low to mid triple-digit euro amount headwind for the full year. We have seen this coming in now at the end of Q2, but it's going to fully unfold in the second half. Our basic assumption is an average oil price of $85 per barrel. While we have seen a lot of volatility lately, while we still believe our basic assumption on the 85 average is correct. And of course, we designed mitigation plan in order to offset the majority of these costs. And most likely we will be successful, but the tailwind of the first half is then missing in the second half.
Okay, let's also just talk about M&A, because you've had the sale of ContiTech to Lone Star. That's been agreed. What are your future plans for M&A, Roland?
Yeah, in general, we're open for potential acquisitions. We have a clear focus. We have a very strong market position in Europe, but we still have a lot of potential in the Americas and also in the APEC region. So if there is an interesting target, we would look very closely. We have a very good situation in the pass car business and in truck, but we have way to go in the specialty tires business. And if we see an interesting target, as I said, we will look very closely and analyze whether it could be value accretive. And if so, we will certainly also find the funding.
I wonder as well how the EU anti-dumping investigation on Chinese imports has been impacting your business. I wonder if it changes some of your pricing assumptions going forward.
So we have now seen at the beginning of July what the European Commission will put in place going forward. It has already led to a lot of disruption because in front of these measures, the dealers stocked up in these tires, and these were weighing also on what we call the sell-in, so what the tire industry is actually selling to the dealers. So whether this has a benefit in the second half remains to be seen. Not so much for us, probably because we are focusing on the premium portion of the market, whereas the anti-dumping measures are focusing on the lower tier pricing segments of the market.
Roland, let me ask you about pricing power, because you've mentioned that focus on the higher tier, and that does seem to be something that we can see in the numbers that has benefited your business, focusing on more luxury products, if that's the right word. What kind of pricing environment do you find yourselves in? How much pricing power do you have?
Well, in general, we try to find the right positioning. And we always balance the volume development with our price mix decision in order to find the sweet spot. In general, we're happy with where we are. We want to grow with the market. We don't want to make market share. So we want to profitably grow. And this is why it's important to find the right price position in general. We focus on the premium market, as we said before, but we also focus very much on the UHP portion of the market. That is the ultra high performance tires, the bigger tires, because they're over proportionally profitable.
Can I ask you about your vulnerability to higher energy prices, Roland? We've talked about how that's going to be a headwind in the second half with higher raw material costs. But how should we think? Now you are a simpler business, having sold off parts of what were previously, Omovio and other things being put up for sale. So does this mean that higher oil prices will drop more seamlessly, I suppose, into the numbers at Continental? How should we think about your vulnerability to higher energy prices?
Energy prices is an important input factor for tire production, there's no doubt, whereas the raw material prices play right now a much bigger role. In order to drive down energy prices, we also invest into sustainability measures. You may have read in our press release that we have now put some wind turbines in one of our German plants in order to drive down the energy cost and make us more independent from market fluctuations. And we will see more of that in the future.
Okay, Roland Welzbacher, really great to have you with us. That's the CFO of Continental off the back of their earnings. Really appreciate you making time for us today. Well, let's pivot back to the markets and bring in Bloomberg's Skylar Montgomery-Koenig. And Skylar, I do actually want to pick up on the earnings theme because we're still looking ahead to SpaceX numbers out later today. And I wonder, given that the IPO became a macro event, what you're looking for in these numbers that would be relevant to your perspective.
Yeah, I mean, it's really interesting because there's so much attention on it because we know we're getting this huge demand for capital this year. And Tesla, or rather SpaceX, was really at the forefront of that with the first major AI IPO that we know we're going to get a couple more later. Now, I will say the questions being asked of SpaceX are really important in that, how much CapEx is being spent, whether that spending you can actually see future earnings come from that. And, with the AI business in particular, when do you actually see profitability? I think where it's less relevant is you've seen more turbulence in the SpaceX price action than you might expect elsewhere. I don't think there's a huge feed through in terms of its very different business models. The market's actually looking between AI winners and losers now. So I'm thinking more what questions are being asked rather than how do those results feed into what I expect from other companies. I'll also say in that there's a major event later this week in that you get the first share unlock. And the question is really, who owns those shares? Will they sell them? Do they see optimism around the future profitability? Or is that another downside event for the stock later this week?
Yeah, and we talked about this as having portfolio effects when it IPO'd, didn't we? Maybe they last. Is this a business with an identity crisis? Seems to be part of the conversation in the Asia session as well. Briefly on the yen then, Skylar, you think that this is, it's a stretch to achieve the goals, whatever those are, for the Japanese and the Americans in strengthening the yen?
Yeah, I mean, with the yen, we're always told that when you have multilateral intervention, that's going to be this major event. And I think this intervention isn't quite convincing in that the way it was done. So the U.S. sold euros, it's been reported, to support the yen. So that tells you that they don't actually want to depreciate the dollar. And there's a scale issue there in terms of the U.S. doesn't have a huge amount of reserves. And then also if it's to support U.S. treasuries rather than to weigh on the dollar yen, then it's not that convincing.
Skylar, thank you very much. Skylar Montgomery-Koenig from the Markets Live team. And just on a programming note, I will be moderating a live Q&A on the Bloomberg website later today. It's all about markets, non-stop trading, 24/7 or something like it. Join us if you want to hear more. This is Bloomberg.